Believe it or not, 2025 could be one of the most taxpayer-friendly years we've seen in quite a while. The IRS has rolled out big changes that will impact millions of Americans saving for retirement. There's going to be higher contribution limits, new ways to use your employer match, and penalty-free withdrawal options. Let's break down what you need to know. But first, welcome back to the channel. If I haven't met you yet, my name is Christian Klassen, and I create these videos to help you make the most out of your retirement. Now, there are new limits in 2025 for what you can contribute to a 401k. So in 2025, employees under 50 can put up to $23,500 of their earned income into a 401k, whereas an employee over the age of 50 to 59 can add an additional $7,500 of their wages into their 401k, bringing the total to $31,000 per year. Plus, thanks to an update in the Secure 2.0 Act, employees between the ages of 60 and 63 can add an extra $11,250, bringing the total to $34,750 towards their 401k during those 4 years. However, it's important to note that employees earning more than $145,000 are required to make up their catch-up contributions towards the Roth portion of their employee plan if Roth contributions are an option. Now, with most 401ks, the employer will offer you a match, meaning whatever you put in, they're also going to match a dollar amount or certain percentage to what you put in. Based upon how they design the plan and limited to what your salary is, if you maximize your contributions, your employer can contribute up to $46,500 for the year into your 401k. Now, saving for retirement using a 401k match can be a great benefit. But what if you need to build an emergency fund or pay off debt like student loans before focusing on retirement? Well, thanks to the Secure 2.0 Act, you don't have to choose. You can do both. Employers can now match contributions either from a pension-linked savings account, which is basically a savings account within your retirement plan, or they can match your student loan payments and put the match into your retirement account. One thing to keep in mind, though, this isn't mandatory for employers. So check with your HR department to see if they offer this benefit. And while it's not generally advised to withdraw money from your 401k early, there's 2 penalty-free options that are worth mentioning. With the fires persisting in LA not too long ago, this is what's called a federally declared disaster. And when you're impacted by these natural disasters, you can now withdraw up to $22,000 from your retirement plan for unfortunate situations like these without penalty. Other thing to note is you are also allowed to take out an indefinite amount without penalty if you're diagnosed with a terminal illness. So while 401ks offer great matching benefits, there are some added benefits with the increased flexibility for people that run into these uncontrollable and unfortunate situations. Next up is the update to IRA account contribution limits. For 2025, the contribution limits have not increased. But just as a reminder, you can contribute $7,000 to an IRA account, and if you're over 50, you do get a catch-up contribution of an extra $1,000 per year, totaling the limit to $8,000 a year. However, there are key updates to the income limits for Roth IRA eligibility and traditional IRA tax deductions. Let's start with Roth IRA income limits, as eligibility is based solely on how much you earn. If you earn too much, you won't qualify for a Roth IRA contribution, unless you use strategies like a backdoor Roth or a mega backdoor Roth, which we'll cover in another video. In 2025, if your income exceeds $150,000, your contribution amount is gradually reduced, and once your income surpasses $165,000, you can no longer make contributions to a Roth IRA. For married couples filing jointly, the reduction begins when your income exceeds $236,000. And once your combined income surpasses $246,000, Roth IRA contributions are no longer allowed. So if you're curious about how these contribution limits phase out, including catch-up contributions, here's a helpful breakdown. So feel free to pause the video to take a closer look based on your income and filing status. And it's important to note that these income limits are not affected by whether or not you have a workplace retirement plan. When it comes to the traditional IRA income limits and the contributions that follow, you usually get a dollar for dollar deduction. However, if you or your spouse is covered by a retirement plan at work and your income is too high, then your tax deduction is either limited or completely non-existent. So if you're single or married filing jointly without a workplace plan like a 401k or 403b, simply put, there are no income limits, so you get the full IRA deduction. But what if you or your spouse are covered by a workplace retirement plan? As of 2025, single taxpayers covered by a plan at work and have incomes over $79,000, you will then only receive a partial deduction for your IRA contribution. This also means if your income is over $89,000, then you'll receive no tax deduction for the IRA contribution. If you're married filing jointly and you're not covered by a workplace plan, but your spouse is, your partial deduction begins to phase out at $236,000 of income and completely phases out at $246,000. Lastly, if you're covered by a workplace plan, regardless of your spouse's coverage status, the income limit is lower and you'll only receive a partial deduction once your income reaches $126,000 and phases out completely after your joint income exceeds $146,000. Now, for business owners and self-employed individuals watching this, you get a few options to pick from. You get to play both sides of the coin as the employer and the employee. Which account is best for you and the main differences? A topic for another video. But in 2025, the maximum contribution to a simple IRA is $16,500 for employees under 50. Employees age 50 to 59 can contribute an additional $3,500, and employees ages 60 to 63 get a catch-up contribution of $5,250. The other types of accounts that self-employed individuals might use are solo 401ks or SEP IRAs. Self-employed individuals will be able to put up to $70,000 for the annual contribution limit into these two retirement plans, plus another $7,500 if they're over age of 50, or $11,250 if they're over the ages of 60 to 63. The reason for these larger limits is because the business owner, you get the benefit of both the employer and the employee contribution limits combined. And you can choose how much you want to match. Let me show you how this works. Let's say you're a 40-year-old business owner making $125,000 a year. Suppose you contribute 25% of your employees' salaries to their retirement plans. As an employee of your own business, you can contribute $23,000 yourself, plus an additional $31,250 from the employer match, totaling a retirement contribution of $54,250 for the year. Now, this is an oversimplified example, but business owners, if you want to see a video comparing these three accounts, leave a comment below. Lastly, one of my favorite accounts, which is the HSA. And this is because most people expect to have health expenses at some point in the future. The true beauty of this account, it allows you to save up for these expenses while reducing your taxes at the same time. All the benefits and how to take advantage of this account are in my other video. Feel free to check it out after this. But the main thing to know is it's required to have a high deductible health plan to be eligible for this account, which the IRS defines as an annual deductible of at least $1,650 for self-coverage or $3,300 for family coverage. If you do qualify, the contribution limit to this account has increased to $4,300 for individuals with self-coverage and $8,550 for family coverage. Plus, if you're over 55, you can make a catch-up contribution and add an additional $1,000 to your HSA. At the end of the day, that's really the whole point of using any of these accounts, taking advantage of tax benefits for expenses we know we'll have anyway. If you're going to retire one day and need money, why not get a tax break for saving now? If you expect future healthcare costs, why not set money aside in a way that reduces your tax bill along the way? If you're trying to figure out how much you need to retire, I have a how much to retire quiz linked in the description below. Thanks for watching. Don't forget to like and subscribe, and I'll see you in the next video.